Welcome to MarketTamer.com. You're looking at a 2-year chart of the Dow Jones Industrial Average, and the reason we're looking at this is it encompasses the peak to trough on the Dow Jones, which is from around the 14,000 area to the 6,500 area over the past couple of years. Now, this is important not necessarily to highlight the correction, but more so to highlight this bounce here, because most people right now are going to be spending time analyzing short-term charts, maybe looking at 5-day or 20-day moving averages, noting that they're pointing higher, price action has been pointing higher, and all of this suggests to them that we should continue higher, and perhaps we will, but the real question is for how long. And to answer that question, we need to look to the big picture, which is the longer term. And a way of doing that is to note, if we look at this price action, we've corrected from 14,000 all the way down to approximately 6,500. Now, that being the case, what is a potential retracement? Well, a significant retracement level in technical analysis is the 50% retracement level. So how do we calculate that? Well, we take the difference between 14,000 and 6,500, which is 7,500, and we take 50% of that, which is 3,750. Then to that 3,750, we add the low here, which is 6,500, and we end up with a price of 10,250, which implies that a 50% correction from high to low could lead the market up to 10,250. Now, obviously, when markets reach retracement levels, they don't get there simply in a straight line. Note this bounce back here has come initially off a V bottom here, and as we continued higher, we've had jagged up days, down days, but we've generally been moving higher. Now, that 10,250 level will be absolutely pivotal, because that's a very, very staunch resistance level when a correction has occurred, when a market bounces back to a 50% retracement level. And as things stand right now, the only way to analyze this bounce is as a bear market bounce. There's nothing underlying in the fundamentals that suggest we should be going higher in real terms. There is a different argument to be made in nominal terms. If enough money is printed, ultimately, the market could go as high as it possibly wants in nominal terms. And so the key thing to think about here is the fundamentals in terms of purchasing power. For example, if we were to note what has the dollar done over the past few months as the market has been going higher, we'll just note that since the market has been going higher, the dollar has been going lower. So if you were to do the analysis, you'd find that yes, in nominal terms the market has been going higher, but the dollars that you now have, even if you have more of them, they are worth less. And ultimately what that says is purchasing power has not increased significantly over the past number of months in spite of the market rally. And this is one of our pet peeves here. When people talk about growth, growth does not necessarily mean a positive thing. Growth could be nominal growth. It could turn out that your purchasing power is declining in spite of a nominally growing market. So always pay attention to the dollar and purchasing power in the context of nominal market moves. Finally, the thing I'd like to note here is the RSI. We're noting that the RSI has actually creeped above 70, and it hasn't done this for a very long time. It doesn't mean that an imminent correction is due. Often markets will stay overbought longer than one anticipates. Another way of saying that is the market can stay irrational longer than you can remain solvent. So we might expect that this could continue for a short period of time, but it's certainly a big indicator that we are overbought and the rally may be on its latter legs. All the best for now. We look forward to seeing you at MarketTamer.com.